Hi, everyone. Thank you so much for joining us today in our webinar series, Part 2, where we will be talking about ASC 606, observations, takeaways, and examples of SEC comment letters. This is Part 2, and if you missed Part 1, you can go back and watch it on demand. It's on our website at softtracks.com. And today in Part 2, we will be talking about introductions and background on Softracks and Effectus Group. So we are joined today by Matt Svetish of Effectus Group, and I'll let him introduce himself a little bit later on. I'll give you some brief background on Softracks and the host here today from Softracks. And then we'll talk about SEC comment letters on ASC 606. What did we expect? And then we'll talk about what did we actually see come through. And then the majority of our presentation will be spent on reviewing examples of notable comment letters with references to ASC 606 guidance. A couple of housekeeping items before we start. If you do have any questions at any time, please submit them in the chat box in the GoToWebinar, and we will either answer them at the end if we have some time, or somebody from Softracks or Effectus Group will get back to you with an answer promptly. This webinar is for CPE credit. You have to stay engaged for 50 minutes and answer 4 of the polling questions to get that CPE credit, and we will be providing you with a certificate after the webinar. So today on our webinar, my name is Kristen Lawson. I am a sales engineer at Softracks, and I'm joined today by Graham Holm, who is the VP of Product Management at Softracks. We are also joined by Matt Svetish, who is a director at Effectus Group. And again, I'll give Matt a moment to introduce himself here in a moment once I provide some background on Softracks. So Softracks is based in Boston, Massachusetts. We are a division of AFS Technologies, and we are specializing in complex revenue recognition. We have over 800 deployments with 0 failures, and we are on our 4th generation of architecture. We actually have the 5th generation coming out in 2019, which is really exciting for us. So be on the lookout for the news. There is a press release out there, and we are very excited about that. Our clients are traditionally software and SaaS-based clients, but due to this change in revenue recognition guidance, we actually are seeing a big uptick in verticals everywhere. So, telecom, media, transportation, Internet of Things, healthcare services, all of it. There are a couple of big clients here mentioned on this slide, and we are expanding that network all the time. So next up, I'm going to turn it over to Matt to give you some background on Effectus Group and himself. Matt?
Thank you, Kristen, and hello, everyone. Really appreciate you being on our webinar today. My name is Matt Svetish. I'm a director with Effectus Group. Most of my career, I've been in Silicon Valley, which is where I'm speaking to you from right now. I've also spent a bunch of time in Boston. Effectus Group is a company that's primarily focused on providing technical accounting services. Everyone from the firm is former Big Four accountants. This year in particular, we've been focused, as is the subject matter on this webinar, on ASC 606, revenue recognition. We've completed between 70 and 100 implementations, and I look forward to sharing with you some of the examples from the implementations that we've had over the past few months, and also discussing in further detail some of these SEC comment letters. Thanks again, everyone.
Awesome. Thank you so much, Matt. Okay, so before we actually get into the weeds on our webinar, I'm going to go ahead and present you all with the first polling question. So please pick one answer. I'll give you about 20 or 30 seconds to respond, and then we'll share the results with you. So the question is, which of the following best describes your company's status to meet the requirement of ASC 606? Again, I'll give you probably 15 or 20 more seconds, and then we'll gather those results and share. All right, I'm going to go ahead and close this poll and share those results with you all. All right, so it looks like 33% the adoption is fully complete, followed by 29% in implementation, and then not started and partially complete. So I guess first things first, Graham, what do you think about this poll? Were you expecting to see people that were already fully complete or in their implementation phase? What are your thoughts here?
I think compared to the polls that we've done and that others have, the numbers, they make sense in terms of the trend. I think if we were to do, we had similar polls a year ago, the numbers were lower, so the trend is going up, and I think it makes sense. And then as I think we get closer to the crunch time at the end of the year for private companies, we'll see that. So this aligns with the expectation that I think we have based on the numbers that we've seen over time.
Yep. Okay. Yeah, I think that makes complete sense. It certainly depends on who's in our audience today, a public versus private conversation. All right, so I'm going to go ahead then and hide our poll results, and we'll get started with our first topic of the day, which is the comment letters and what did we expect. So as you can see here, we highlighted one article that we found during research by MarketWatch, and Kyle Moffitt, the chief accountant for the SEC's Division of Corporate Finance, made the following comments. We aren't planning to beat up companies in this first year, and it is too early to say what the result will be with respect to more or less letters, but the staff will be taking a look at some of those filings. And personally, I think that's a really great first comment. We aren't planning to beat up companies in the first year. I'm glad they're not playing bad cop. So I guess I am going to turn it over to Graham to give us some initial feedback on what we expected.
Thank you, Kristen. I think in terms of, this is a good comment to the extent that I think it played both sides of the fence to an extent, meaning, the FCC's comments gave companies breathing room for year one, at least back when May, at this event, which was right around the midpoint of the calendar year. But it left the door open so that as we move toward the latter part of 2018 and into 2019, that the comments may become sharper and there may be higher expectations in terms of conforming and really adhering to 606's requirements. And so, that was the takeaway, at least from my end, and just in talking with additional people, analysts, colleagues, et cetera. And so I think it's important both on the public side that even if you've adopted, that you continue to mature your processes, procedures, and just what you're putting in filings, because I think the SEC's eye will be sharper on those results going forward. And then for private companies, the benefit is they can look at the progression over the year in terms of the filings and the comments on them, and use them to help with best practices and lessons learned as they're moving ahead with their implementations. Matt, any thoughts related to that?
I would just say, to your last point, benchmarking is one of the most important things we can do as a private company as well as a public company. I think companies oftentimes get in the habit of thinking of themselves as the exception because just by nature, for example, if you're in a startup, your product needs to be exception. Otherwise, how would you be competing in the marketplace? But the exceptions don't need to be brought over into the accounting world. So it's always best to benchmark yourself against other companies. And now that we have the benefit of some of these SEC comment letters, it's a perfect time to discuss that benchmarking activity.
I think that's a really great point, Matt. And I think that is exactly what we will see. So this first slide was talking about what we are expecting. And now this next slide is what did we see? So here you can see a couple of indicators or things that were frequently targeted in SEC comment letters. And they're just headers. You can see here measurement, determining transaction price, a couple of disclosure headers on contract balances, performance obligations. So here we're finally getting into the weeds on those disclosures and those comment letters. And they're kind of, providing that oversight into the deeper dive of what companies are providing from a disclosure standpoint. So Graham, can you please comment on what did we see?
I think we're about to get into some detailed, comments from the SEC on companies' filings. I think boiling it up before we start and get into those, I think the takeaway that really I had and would want to put forward on this is that it's imperative that in these filings, and then really as private companies adopt, that the key points of what, when, why, and how, answering those questions as you're going through each significant component of the guidance for 606, it's paramount. And so to that point, and it's something that I've used in terms of thinking through this, is there's a certain amount of art in terms of the qualitative information that companies put forward in their filings, and then there's the science part of it with respect to the quantitative information. And so, that's something that as we go through these examples, my eye trained on, and I would, ask the audience to think through it as well, because as we move through, answering the what, why, when, and how questions allows you in many cases to cover these areas with the level of detail so the comment letters don't necessarily come your way, or if they do, they're on a very specific topic versus asking an open-ended question such as, did you comply at all? Matt, anything to add there?
I would say that, there's a lot of bullet points here covering a variety of topics. I mean, it pretty much looks like all of 606 in some ways. Understanding the nomenclature is a big part of the battle here. So making sure that the nomenclature is clearly articulated both in your technical memos and then within the filings themselves, and that it's consistent. That's a place where you would want to put a lot of emphasis on, and making sure that the nomenclature is not only just understood within the accounting department, but amongst the management team as well, because sometimes there can be a disconnect between that and between the management team, the accounting team, and you can see that disconnect when comparing the MD&A section versus the footnotes in the financial statements.
Great. Okay, so the next thing actually that we are going to do is look at some of these notable SEC comment letters referencing ASC 606, so we can really see and deep dive down into whether or not companies did what you both mentioned in terms of covering all their bases on qualitative and quantitative information. So we have here presented a number of examples, and the first one being, and I'm just going to brief through it, your disclosures suggest that you did not adopt ASC 606. If true, please tell us why you did not. And if you did adopt ASC 606, please revise your filing to provide the disclosures required. And we've also noted on each of the appropriate slides the guidance below if you need the reference. But I'm curious, Graham, what you think of this.
I think this one was selected simply because it's pretty straightforward. It's self-evident to an extent in the sense that the SEC's comment is effectively asking, did you comply or not? And I think it's not something that you would expect, but I think it goes to show that any ambiguity or just lack of information could lead to this type of question. And so I think by the company, it opened itself up for this type of question due to the fact that it just wasn't transparent in terms of what it did for 606. And so it was at the top, or you could call it the bottom of the pyramid, depending upon how you want to look at it today, in terms of something that you just want to avoid, obviously. But beyond that, we'll see in these upcoming examples, just saying you adopted isn't enough. You're going to have to cover the 4 areas listed below in A through D with respect to the revenue recognized from contracts with customers, contract balances, performance obligations, and then your significant judgments. And so, I think this one was, I would call it a red flag one that really made sense to start out with. Matt, what's your view on this? I know we had some preliminary discussions when we were going through this, but this is pretty egregious, might be a strong term, but it seems to be something that you just expect a company to cover out of the box, but this comment seems to tell otherwise.
Yeah, and sometimes it's hard to tell, what was in the minds of the company when they decided what to disclose and what not to disclose. But my view on it is these 606 projects tend to be fairly involved. They take a lot of time. and effort. And sometimes it takes just as much time to come back to the same accounting answer that you had under 605 than to come up with a different accounting answer under 606. So what I would say is just take credit for all your effort and state, how you reach that conclusion in your disclosures, both in terms of if you're a public company and if you're a private company. Specifically on a private company side, the investors are going to want to know, well, you just spent, X number, hundreds of hours on the 606 adoption. How is it that you came to the end result that there was no material difference? It's worth at least including a few sentences in your disclosure footnote to articulate that point.
Yeah, I think that's a really great point, that people should be taking credit for all the hard work that they're doing to comply with ASC 606. And I think that's a good thing for us to note here in this next example. And I'm not going to read this one to you guys, but just in summary, this company said that the changes were not significant to revenue in the timing or nature of recognition. However, they didn't outline how they complied with ASC 606. So this example is kind of the SEC is, reminding them of the guidance in Rule 10 and asking them for more information. And I think, to your point, Matt, they did not give themselves any credit, and they didn't actually outline the changes that were made. Graham, what are your thoughts on this example?
Yeah, I think, piggybacking on what Matt said, I think it's, taking credit for the work that you do is important, because in this case, the comment goes to a question of how thorough was the company, or, at least disclose to us how, what your considerations were. So they did get into the area of disclosure related to disaggregation of revenue, but then there were other areas of disclosures that just weren't touched on, which led to this question. And I think it goes to the point that even if you've identified that as a company that you haven't qualified for certain areas of the disclosure, you're going to take advantage of a practical expedient, what have you, it's important to take that credit and put a level of detail to explain to the reader, what you did or did not do, or did not qualify for in terms of the guidance, or elect to take advantage of, so that ambiguity is just, it's wiped away. And so this was, I think, maybe a level deeper from example one, but it still wasn't deep enough in terms of explaining, all of the areas of disclosure that need to be touched on to have a comprehensive filing that for 606 that the SEC can look at and move on from without comments. Matt, what's your takeaway when you look at this particular example?
Yeah, I would go back to how we started the webinar and talk about the whole benchmarking. Find a company that's public that's already completed their disclosures and compare your company's disclosures against theirs. That's a great starting point. And on top of that, KPMG has a guide that's just for disclosures. It's separate from the regular 606 guide, or the general 606 guide and the SAS 606 guide. There's a third guide out there. And I would definitely recommend getting a hold of that KPMG copy, because it'll be helpful in articulating the finer details of what disclosures you should make, and also discussing disaggregation of revenue, whether it be by geographic region, market type, or good or service.
Thank you. That's a great resource, that KPMG guide. And going back to what you said about, benchmarking and these companies comparing to public companies who have already disclosed, we're going to jump to example 3 here. And it says, you state that you have preliminarily assessed the impact the new revenue recognition guidance, except or including but not limited to the presentation of sales tax. And then it kind of goes on to say, please provide a qualitative discussion of the potential impact that it's going to have on your financial statements. And then again, ask for more descriptive details associated with that qualitative discussion. And so I think my advice to this company would be to go to have, if they have just started this assessment, to go and look and see what other companies have already done, and then use that as a benchmark when they're responding to the SEC. Graham, what's your take on this example?
I agree with that, Kristen. I think fundamentally this comment drills into the company's assessment of 606 to date and what they expect the impact of adoption to be. So, yet to adopt, but they put some language in their filing, and it led to these questions from the SEC. Now, I think to an extent, it's helping the company because it's obviously telling them, all right, these are the things we want to see, and you haven't adopted yet, but please explain it to us now. But it also sets the stage for when adoption occurs. You already have the roadmap for what you need to do. And to your point, Kristen and Matt, you pair that with, any publicly available information on filings to date where adoptions have occurred, and you have a solid benchmark against which you can answer this question and make sure your filings going forward are comprehensive. So that's the initial takeaway. I think the second piece is just, it goes to the point that I mentioned earlier about having an art component in terms of the story you have to tell, and then the science in terms of the numbers to back it up on the quantitative side. And so in this case, the SEC specifically calls out, please provide a qualitative discussion of the potential impact. And so it's important, in my view, to paint the picture, tell the story, whatever phrase you'd like to use. But that is very important in terms of, as this company moves forward, it's not just providing numbers and then saying we adhered and adopted 606. They're going to have to paint the picture that addresses, the disclosures that we looked at in examples 1 and 2, and really give a comprehensive presentation as to how they're meeting and satisfying the requirements and the impacts from those. So that was my takeaway here. It wasn't just numbers; it's matching that narrative up to it so that the reader has a full picture. Matt, any view from your end to supplement this?
Sure. What I would say is just to expand on that comment, to think about entity level controls as well as controls within your quote to cash process, particularly where it's like Graham said, not just numbers involved. Oftentimes we're seeing companies needing to add additional qualitative controls into their control matrices in order to make sure that any assertions that are described are properly vetted. And this can sometimes take longer than actually coming up with the numbers, so to speak, especially when you think about all the different decision makers that are involved in what assertions are made in these disclosures. So think lawyers, all the management team, plus the accounting, maybe even sales has some input. So it's important to make sure that every one of the key players, has some input and that it's properly aggregated within a control structure that will prevent any significant deficiency or material weakness from arising.
That was a really great suggestion, Matt. Okay, so before we actually jump to example 4, I'm going to initiate our next polling question. So again, please go ahead and take 30 seconds to respond to what areas of your company were most impacted by ASC 606 requirements. Give you 5 or 10 more seconds, and then I'm going to close it out and we can share those results. All right, so a vast majority of you are saying finance and accounting. I suppose I'm not very surprised by that. Graham, Matt, what are your thoughts on this?
I think, this is Graham, I would say, I'm certainly not surprised. I would say, to Matt's point, in what we've heard and what we've seen with the customers that have purchased the SoftTrack solution to automate 606, is that wide swath of coverage that 606 has across different departments and areas. So I'm not inherently surprised that we're seeing, other categories get a certain percentage here. I think, definitely it's not surprising. I think it seems finance accounting is taking the brunt, but to Matt's point, this isn't within the walls of finance and accounting. It affects how you sell. It affects how you effectively run your business from an operational IT standpoint. And then, obviously how you structure your contracts from a legal standpoint. So this makes sense. I'd be interested to see this as private companies adopt, and we see that. So, but definitely makes sense for the publics. Yep. Matt, what are your thoughts?
Yeah, I would say, just looking through this, what I'm thinking about is the company roadmap or product roadmap that we're all aware of, particularly in the IT world. I'm thinking of situations where we've had companies and we've documented under 606, for example, they're under term license, but sales had and upper management had decided that the company was going to move over to a SaaS platform, but that wasn't communicated back to the accounting team until much later. So making sure that the product, when the ASC 606 adoption occurs, that you're not just documenting what you're doing at this point in time, but also what you expect it to look like in the future. I think that's really important to consider.
Thank you, guys. Okay, so jumping then to example 4, it just plainly says, please revise to describe the factors that could impact the amount and timing of revenues being recognized in subsequent periods. Now, I think this is really straightforward, and I almost want to say less is more, but I know that in most instances, they're actually asking for more. So, Graham, what can you tell us about this short and concise request?
No, I agree. I mean, in terms of, it's short, but it packs a good amount of punch in the ask here. I think it's short, but the answer needs to be, more might be better in terms of the answer to support the company's assertions. And so, to that point, explaining, the factors such as, why, performance obligations are recognized over time, point in time, and, all the considerations to that, that's obviously something that would be inherent in the answer here. I think also a consideration, and I'd be interested, Matt, for your input on it, is the company has to take care to represent how it applies a timing approach when they answer this question consistently across similar contracts. So the answer should be such that, okay, the answer's put forward, the timing and impact is put forward, but then if the SEC or a reader is to look at, let's say, results in a similar type of scenario and the timing's different, it could expose the company to additional questions. And so I think consistency in how the timing approach is applied is something they would want to address in the answer as well, or at least making sure they're covering off that, they feel confident the data both qualitatively and quantitatively is covering that. Matt, anything to add there?
Yes, I think that, when I took the initial read through the 606 guidance, it was interesting because of when it talked about timing. The way the guidance reads is there's an expectation in many ways that your revenue is going to be recognized over time. There's criteria for overtime recognition. And then if it fails the overtime recognition, then you recognize at a point in time. So being able to describe and articulate how for each revenue stream, the conclusion of overtime versus point-in-time revenue recognition was achieved is really important, both in terms of responses in SEC comment letters as well as in your disclosures.
Yeah, I would agree. I think this conversation that we're having about qualitative and quantitative information, they're both very relevant and very important. And I think here in our next example, for example 5, I'll read some of it in a moment there. I think in this instance, this company presented quite a bit of quantitative information and they may be lacking that qualitative narrative. So here the example says, please tell us or disclose information about remaining performance obligations or the application of those optional exemptions. You state that sales to your largest customer represented 22% of the total sales for the year under a long-term contract. Then they also state that they typically sell those products with contracts under 2 years, so with 1 to 2 year terms. So I think there's a discrepancy between, what they're disclosing about those exemptions, whether or not they're using that remaining performance obligations exemption, and sort of what's going on behind the scenes, because there's this difference in what they've presented from a quantitative perspective and a qualitative perspective. Graham, what are your thoughts here on this example?
I mean, you really hit it, right where I was intending to, in the sense that it's a good example where, in my view, they filed, but there was information both in prior filings and the one that was being reviewed that indicated, okay, you're qualitatively you have information that's countering the quantitative information, and so it's really the comment is really a which is it comment, or call it a question. It's either you need to disclose more information on remaining performance obligations due to having long-term contracts, or explain why you don't think you're required to do so and taking advantage of a practical expedient. And I think the idea that, all right, there's data out there that tells us, it's not immaterial is another key point. So I think, to your point, Kristen, and then to extend it, I think it's really a which is it type question. So the companies are going to have to answer and reconcile what they put forward as of their filing at the end of the calendar 2017 year, and justify why they don't think they have long-term contracts. So that was my view on it, and it was a good example where the SEC is, it's not just reading, it's comparing, okay, quantitatively, qualitatively, something doesn't match up here, which is it? That's how I read it, Matt. What are your views on that? Is it something you've seen where that qualitative and quantitative matching is disjointed, or is it just a matter of getting, as companies are adopting, them getting calibrated to presenting information on an even par with respect to both types of information?
Yeah, so a few thoughts on that. I mean, one side of me, I have an auditing background, so we're always, as auditors, looking for discorroborating evidence with any assertion. And in this case, we can see within the paragraph the discorroborating evidence, and understanding how that can kind of be raised to the surface is really important in the ASC 606 adoption. So for example, if the company says we believe revenue should be recognized at a point in time or over time, then go and look at all the examples where revenue is recognized at a point in time that may be similar to your company, and understand how they reach their conclusion and how it is not the same as your specific scenario. So I think going through that exercise, that mental exercise, is very important. Also, just with messaging takes a long time. It takes a long time to write it out from a qualitative standpoint. So spending time on your financials, on the MD&A section, and comparing it back to your board presentation is also a very important like reference point. So just to say it again in summary, there should be like this triangle of information, right? The board presentation, the MD&A section, and the financial statements. All of those documents should essentially be talking to each other using the same vernacular with the same assertions. If there's inconsistencies, that's when you end up with some comments like this.
Okay, so I'm just going to jump forward. We did include, again, the guidance here, but it was quite a bit for you guys to look at. So I'm just going to jump forward to example number 6. So it says the basis of estimates were subject to change in the future due to events that they had little or no control over. And the SEC here is asking them to explain sort of what estimates were used and how they may result in inaccurate forecasts by analysts and investors. And I'm actually really glad, Matt, that you brought up your last point in terms of presenting, the MD&A and the, sort of the forecasting information, the financial statements and everything to your board, because ultimately the goal of ASC 606 was this comprehensive view for analysts and investors and shareholders. And I think it's really important that you provide your information to them in a way that is easy to understand, that's very transparent. And I think the problem that they're having with this example is they're asking, what future events are really going to lead to this discrepancy in your forecast, or what do you not have control over? You need to just kind of explain that so that people aren't left wondering what could possibly happen. So, Graham, what's your take on this one?
I think I'd make two quick points. I think the comments ask is basically remove the ambiguity that's in your filing with respect to, okay, okay, you have estimates. How did you arrive at those? And then, but then you're couching, then the comment is couching it saying, well, they could change based on events that the company has little or no control over. I think that type of ambiguous, statement is to an extent, it's not the friend of a filing in this case, right? And so to your point, Kristen, that's point one. I think the second piece is, so you have to remove the ambiguity there. I think the other piece is that at least in the first year of adoption, more might be better in the sense of and this goes to your point, Matt, earlier, take credit for what you've done. It could very well be that there was a good amount of time spent here by the company on those estimates, but it just wasn't articulated or put forward in the narrative and in the qualitative information that the filing contained. And so I think it goes to that point that you really want to, besides eliminating the ambiguity, spend the time, as Matt just articulated, to put forward the level of detail that's needed to really take credit for the work that was done. I mean, that's my takeaway when I read this, and then also listening to Matt's points as we move through today's presentation. Matt, anything that you'd like to add to this particular comments?
No, Graham, I think that was really well said.
Okay, thank you.
Okay, well, with that, we are then going to launch our third polling question. Okay, so again, please go ahead and take a little bit of time here to answer the following question. Which ASC 606 disclosure requirement is the most complex and or challenging for your company? All right, I'm going to go ahead and close this poll here in a second. Still got some answers churning in. All right, and we will share those results with you. So the disaggregation of revenue came up as number 1. Number 2, presentation of contract balances. And number 3, those significant judgments determining the transaction price, or the timing, determining the timing of recognition. All right, so I guess I will then ask Matt, what are your thoughts on this result?
I would say that I'm not surprised on how spread out it is because 606 is so impactful across different types of transactions and different documents and whatnot. The one thing I would say is the disaggregation of revenue at 28% does seem a little bit high to me, and the reason I mention that is because the disaggregation of revenue should really just be a reflection of how the company views its business in the first place. So as long as that, how the company views its business in the first place has already been articulated internally, it shouldn't be too bad in order to get to the disaggregation of revenue from a qualitative standpoint. I think from a quantitative standpoint, that's when IT and the software programs that you have become involved and could potentially be a little bit of a lift. The other item that I would point out here is the significant judgments in determining the transaction price. This only got 13%, but I will say a number of our companies have had some challenges in determining the transaction price, particularly when purchase orders are across multiple years. There's some judgment in determining whether or not the transaction price includes the purchase orders, for example, for all 3 years in a blanket purchase order arrangement, or maybe it just includes the first year related to a 3-year purchase order. So different things to consider, but I'm not surprised on how spread out it is.
Okay, great. So I'm going to go ahead and jump us then to our next example. All right, so I'm actually pretty excited. The next couple, we're not going to provide you with any more, very guidance-heavy response or comments, but we do have some SEC or company responses to SEC comment letters coming up that Graham and Matt are going to walk you through. So example 7 here says, please describe to us the type of engagements that result in professional service revenue being recognized upon completion of the contract. And this will be a really nice technical accounting discussion. So Graham, what are your thoughts here on their completion of contract method?
Well, I think the reference to it is, was interesting because to Matt's point, a few minutes ago, one of 606's tenets, as you read through it, is to recognize revenue over time where you can, and then move into, alternate approaches, right? And so in this particular case, there was enough information on the filing that led to the question of why would you consider professional services revenue to be something you have to recognize at the completion, whereas in many cases it lends itself to be an overtime as delivered type recognition approach. And so immediately I think it caught the eye and it led to this question. I think the response was telling because, effectively, there was a quick revision done, and while the revision by the company indicated effectively that substantially all of their contracts for professional services are based on time and materials and delivery, but the one comment in there is that there is an immaterial amount that is still based on completion of the contract method, but that the vast majority is based on as delivered. And so it was interesting that the company, to an extent, did quickly revise based on the request from the SEC. But it goes to the point, and I think that Matt hit on that. If you're planning to do something other than over time, let's explain why. And especially if in light of the fact that you're going to use the completion of contract method, you're really going to need to support it with that information qualitatively and quantitatively to make sure it's justified and that the assertion's complete. Matt, anything beyond that really strikes you from this particular comment?
Yeah, I would just say, under 606, the completed contract method, as it existed, let's say under US GAAP, is not permitted under 606. So the fact that the company reached this conclusion, makes me think about whether or not they thought they could potentially have been the exception, right? And which is what I opened our discussion talking about, was making sure that whatever accounting conclusion you're reaching, you're not the exception in the industry. In this case, if they were, for example, recognizing a bunch of contracts on a completed contract basis, this would be an exception. After reading their response, it makes a little bit more sense that it was just a small immaterial amount, but it's something to watch out for.
Okay, great. So that's going to take us then into example 8. Example 8 is asking, you disclose that when upfront fees provide the customer with a material right to renew, those fees must be deferred and amortized into revenue over the typical contract term. Please clarify what you mean. And I think that really sums it up and goes back to what you both were just saying. Please clarify what you mean. So think about those qualitative and quantitative presentations, and they really come back right here to bite this company. Please clarify what you mean by those material rights and that contract term. Graham, what are your thoughts here on this one?
Yeah, I think the fundamental takeaway that when I read this was, as a reader, a typical contract term seems innocuous by itself, but if you're not part of that company or its management, or how would you know what that term represents and what went into effectively calculate or determine it? And so I think Matt used a good term earlier. The vernacular that's used within the walls of the company needs to be consistent across all the documents that are used to then file with the SEC, and then publish publicly available reports. But beyond that, I think within those documents, it's imperative that if there's a company-specific term, no pun intended here, that it should be defined so that the reader can really appreciate it. So in this case, the typical contract term, what is it? How did the company arrive at it? And so the company's response was solid in that they explained what the term meant, and effectively that they did incorporate renewal periods into the typical contract term because of their consideration of upfront fees representing a material right. But they provided that level of detail, the story, as I called it earlier in the discussion, that I think if they had done more upfront, it would have circumvented this comment. Fortunately for us, it provides a good example. But make sure everyone's speaking the same language, which is really parroting what Matt said, is important. both internally and then externally when you present your information. Matt, what do you think?
That's well said, Graham. I don't have any other comments on this one. I think it's pretty clear, where the updates needed to occur related to this disclosure.
Okay, thank you.
Yeah, so in this example 8, we talked about a material right, and the next example that we're going to talk about goes through a variable consideration question here. And so it says, we note that with respect to certain multi-year contracts, sales are based on amounts appropriated by the government. Please explain to us why unfunded amounts are not treated as variable consideration in determining the transaction price. And variable consideration has been a really big complexity within this new guidance, and it's caused quite a bit of fuss. So I think this is a really good example to start out with and to kind of piggyback off of that material rights discussion. Graham, what are your thoughts here on this variable consideration example?
I think per our last polling question, and Matt, you referred to it, determining the transaction price, that percentage might be low relative to what you've seen. I don't want to put words in your mouth, but that was what I noted. And then that aligns with what we have seen when we've done our analysis of filings and comment letters as well, is that variable consideration comes up frequently. And when it comes up, it certainly, it has a level of complexity that I would say is higher with respect to the types of questions than the ones we've looked at earlier in this presentation. But I think in this case, it all centered on, all right, why would you consider an unfunded amount something other than variable consideration in determining the transaction price? And it points to a very specific area of the guidance. The company's response goes through a number of considerations, notably that, effectively that, while the portions of the long-term contracts may not be funded, they have a firm order for those goods or services, and they feel it's probable that the customer will fund such amounts. But then they clarify very clearly that, yes, we will revise and make it clear that the unfunded amounts are part of our variable consideration, and explain how we go about calculating that. And so, I think this certainly hits on the point Matt made, that determining the transaction price can be an area of complexity that I don't want to say sneaks up on companies, but that is presented as they're doing their analysis on 606. Matt, what have your experiences shown?
Yeah, Graham, I would actually, I would say it does sneak up on companies, because, for example, if you have a SaaS company, typically you would expect your revenue to just be recognized ratably, but there may be, a guaranteed minimum amount, substantive guaranteed minimum amount that you're going to sell to that company each year, and then any amount over that could be potentially considered variable consideration. So even in what typically in the past had been viewed as very basic, ratable recognition scenarios, variable consideration may still need to be applied. So it's important to really watch out for variable consideration, and also understanding the differences between variable consideration and, for example, a material right that we had in example 8 in the contract. That may not always be clear to companies at the beginning, although it does become more transparent as the adoption process continues forward and each performance obligation is more clearly identified.
Yeah, I think that's a really good point, that we will have to be very mindful of those contracts and those contract terms, which is why we had asked earlier, whether or not that legal department would be affected in this guidance change, because we do have to pay attention now to contract terms and the way we sell things, to determine, whether or not these contracts are just ratable or they have variable consideration or material rights components. Okay, so that actually takes us to another variable consideration example, and this one actually has a lot going on here, so we're going to spend a second going through it. It says, you indicate that you estimate variable consideration using the most likely method, and that's outlined below. And it says, please tell us why it is appropriate to apply this method rather than the expected value method. And then in addition, please tell us where you have made the disclosure specified in the guidance on your consideration for providing this disclosure. So a couple of moving parts here. The two methods for estimating variable consideration amounts are listed below, and they've used the most likely amount, which, just to summarize for you, is pretty much in the first sentence here. It's the single most likely amount in a range of possible consideration amounts. That's pretty straightforward. And they did not use the expected value method, which, as you can see here stated, is the sum of probability weighted amounts in a range of possible consideration amounts. So that one has a little bit more significant judgment in there. And then, they're also asking us where you have made the disclosure specified in 12B, which below is talking about, disclosing information about the obligation, including significant payment terms and significant financing components, the consideration that's variable, and all these things. So they're looking for a lot in this example. Graham, what can you tell us about this one?
You did a very good job, Kristen. You covered a lot of the areas that I think make sense from our standpoint. I think the one thing I would add here is I think when I read this, and I want to give Matt a good chunk of time, because this does get into, to an extent, the weeds of technical accounting side. But I think when I take away, my takeaway from this comment, is the how, right? And they didn't answer that question, to the level that was needed to explain why you would use one method over the other, and then support it quantitatively. And so, I think that question needs to be answered. How did you arrive at the selection of, one method over the other, and then spell out beyond that, why you are saying that, that's the case? And so I think, Matt, in the essence of time, I wanted to open the floor to you in terms of, what your experience has been in terms of companies looking at either of these two methods and assessing them to apply to what they do and figuring out which one is most applicable.
Yeah, I would say that, whether you choose the expected value method or the most likely amount method may actually vary by industry. So again, this is an opportunity to look at what other companies are doing in terms of their variable disclosure, if, for example, they're in your space. So think software security versus online ad companies, right? The other aspect here, which is interesting, is I believe the company started with saying that they're using the most likely method, and then they, at the end of the day, chose the expected value method in their response. And so I think part of that is just asking yourself, whatever decision you make, you say, oh, I want to go with method B. Well, why is A incorrect? Speaking back to the point of any discorroborating evidence that would support, a different conclusion. Look at both methods and really determine what works best for the company and how it benchmarks against other companies. One specific point to point out on the most likely amount method, it's really almost like you're choosing between this or that. So you're choosing between two possible outcomes, versus the expected value is more, think about it, your econometric classes and whatnot. It's a sum of the probable weighted amounts. So for most companies, that should be fairly clear, but definitely for some companies, they operate in a little bit of a gray area on whether there's really 2 or 3 possible outcomes or whether they need to apply the expected value method. But either way, test both methods before reaching a conclusion. Don't just try and jump to the conclusion, document it, and then find out later that there was a better answer.
Yeah, I really like that recommendation, stick to what you're going to do. Okay, so we do have one more example, and I know we only have about 5 minutes left, but I do need to make sure we get in our last polling question. So I'm going to go ahead and share our last polling question with you all and quickly get those responses from you. So please take about 20 or 30 seconds to answer. How did the determine the transaction price step of ASC 606 and its detailed requirements, such as variable consideration, impact your company? All right, let's take about 5 more seconds. That percentage of voting is climbing. All right, I'm going to go ahead and close the poll. And I'll go ahead and share the responses with you all. We had 51% average impact, 30% at minimal, 15% at significant, and 4% at no impact whatsoever. And actually, because we're running short on time, I'm going to go ahead and jump us now to example 11. And we'll just quickly talk through this slide. Oh, sorry. Go back one. All right, so example 11, please provide us with your analysis regarding payments to partners. Please describe in detail the nature of these payments and clarify when payments are classified as marketing expenses as opposed to recognized as a reduction in revenue, and the guidance is stated. So Graham, what are your thoughts here on this one? No thoughts from Graham.
I think we may have lost Graham.
No, I'm here. I'm sorry. So I would say is that on this particular one, my takeaway is that there's significant judgment related to this particular how the company would need to answer this question and adequately, in the sense of when we've looked at filings in this area, the takeaways, there were a number of things that companies put forward as what they considered consideration payable to a customer. So, for example, did they provide third-party goods or services at no charge or significantly reduced charge to the customers or to the partner? Did they provide discounts or credits on prices of existing goods or services? And then the third thing that was put forward as a potential, consideration payable to the customer is, did they offer new services or goods at no cost? So there was a good amount of what I saw judgment being applied in terms of areas that they needed to consider as to whether it would fall into the category of a payment consideration payable to the customer. I think additionally on this one specifically, just quickly, it would be that other factors that were considered were, how was the product sold? Was it sold at standalone retail price by the partner, or was it part of a larger bundled services, and who collected the payment? All of those factors would lead into the answer or be considered in the answer that the company would need to put forward to adequately address this comment. Matt, what are your thoughts?
No, I think you articulated it very well. I don't have anything additional to add on that one.
Okay, thank you.
Okay, great. So that was actually our last example. So I'm going to go ahead and push us into our next slide. I did have some really great questions come up. And for those of you who are asking, this will be on demand later. And so if you want those resources from earlier, they will be available, the KPMG guide, the softtracks.com webinar links, etc. But here I did just want to note that we have upcoming webinars. So if you enjoyed this one and you want to see the next webinar in our series, it will be in October on what should we expect regarding ASC 606 going forward. And then in November, we'll talk about how automation can address ASC 606 requirements, reduce costs, reduce audit and compliance risks, and benefit your company. I also want to thank our co-hosts. Matt, thank you so much for joining us today. And Graham, thank you very much for your insight. You guys did a wonderful job. If anybody would like to reach out or ask additional questions, our contact information is there on the bottom. We would be happy to field any additional questions and we'll answer them appropriately. Otherwise, that's all we have for you guys today. Thank you so much for joining us. Again, CPE credit will be awarded for those who stayed engaged for 50 minutes and answered our 4 polling questions, and we will be sending out those certificates here in the next few days. All right, well, thank you for joining us.